Here, and in today's video what I want to talk about is the new corporation tax increase that's coming in April 2023. So it's been a bit of a roller coaster with this corporation tax increase, because I believe it was Philip Hammond announced it a couple of years back. Then Rishi Sunak didn't do anything about it, and then Liz Truss and Kwasi Kwarteng reversed it, and now the new Chancellor Jeremy Hunt has brought it back in. So the reason I haven't really done this video before is just no one knew whether it was coming or going, but I'm assuming Jeremy Hunt's the last Chancellor we're going to have for a little while. So let's just assume it's actually happening. So corporation tax increase, it's coming in April 2023. Unless that changes, I will let you know if it does, but everything's changing at the moment. Okay, fine. So new corporation tax increase, it's coming in April 2023. And what you may have heard is like corporation tax is increasing from 19% to 25%. But it's not quite as drastic as that. So this video is talking about why it's not quite as drastic. So at the moment, and in the future, if you earn up to £50,000 in profit in your company, then you'll be taxed at 19%. So, and currently, if you earn more than £50,000, you'd still be taxed at 19%. But what the new rules are saying is when your profits in your company go over £50,000, you're going to see an increase in the rate of corporation tax. So the first 50 is always going to be taxed at 19%. But then if you make more than £250,000 of profit in your company, well done. But if you make more than £250,000 of profit in your company, then the corporation tax rate is going to go up to 25%. So anything over 250, you pay 25% tax on. So below 50, it's 19%. Above 250,000 profit, it's 25%. And then you've got this whole thing in the middle between 50,000 and 250,000. And this is where they apply a principle called tapering. And what tapering is essentially that the rate gradually goes up. So what happens is, like, for example, if you made a profit of 100,000, you might have a corporation tax bill of 20% instead of 19% on anything above that first 50,000 you made. If you made a profit of 150,000, you might have a corporation tax bill of 22% instead of the 19% that you're paying on the first 50,000 you make. So what happens is, on every depending on what your profits are, on every extra bit of profit you make, you pay an extra percentage of tax. That sounds really complicated, but luckily there's great software out there that can calculate it all for you, or for us, if we're your accountants. But this is essentially how it works. So you're not, just by flicking over into this higher profit, you're not going to suddenly pay more corporation tax on everything you earn. You're just going to pay the extra rate on the additional amount you earn over that 50K. So this is interesting, but what it means is maybe the strategy in terms of business, a lot of people's strategy in terms of business is potentially going to change as well. So if you think about it, at the moment, if you're taking a lot of money out of your business, you might say, actually, by the time we paid all this extra dividend tax and then we've paid all this extra corporation tax, we're not left with a lot. And it doesn't make sense to take all this money out of the business to then stick into savings accounts or shares or ISAs and any other investments, because you're losing so much up front that the trickle that you're getting in through investments is just not worth it. So this might actually be a good thing for the economy, because it could get people to rethink how they invest in their business. If you think about it, capital gains rates are still relatively low. So capital gains tax is about 10% on a business, unless you sell it. If it's over $1 million, then the bit over $1 million goes in at 20%. So it's quite a low rate. So you may be in a position where you think, well, you know what, instead of making all this profit in my business, I'm just going to start reinvesting money and just driving up the value of the business by reinvesting that money in the business. Obviously, reinvesting money is an expense. It's an investment, but it's also an expense. So it lowers your corporation tax bill, so you save on that corporation tax. But what it also does is, if you do it right, it will increase the value of your business. So one day when you come to sell it, you will essentially get a lot more money for it, and that the more money you get will be taxed at the capital gains rates rather than corporation tax rates or dividend tax rates. So it's just all I'm saying is now we've got these changes coming in. You might want to just rethink the strategy you've got with your business and how you take money out. Obviously, you might be thinking, well, if I split my business into lots of little businesses, I'm sure there's just the same way with VAT, they'll have anti-avoidance rules around it. So we'll have to be careful about that. But if you want to find out about this or anything else relating to accounting or business growth, go to our website, naccounting.co.uk, book yourself in for a strategy session with ourselves. And also, I just want to tell you about our quarterly planning day that we're running on Wednesday, the 7th of December. And it's a great opportunity for you to come and spend the day with myself and my great team. We've got some amazing clients who are joining us as well. And what you'll be able to do is just listen to some really good speakers, network with like-minded business owners who are ambitious and will go places. And you walk away with a solid 3-month plan to achieve the actions you need to grow your business. So take me up on that. Go to our website. All the details are there as well. And I will see you